Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. This is the first episode of 2025, and I have the perfect guest to kick things off. Eric Balchunas needs no introduction. He's a senior ETF analyst with Bloomberg Intelligence and the author of two excellent books on ETFs, the Institutional ETF Toolbox and the Bogle Effect. And he co-hosts the Trillions podcast and ETF IQ on Bloomberg TV every Monday. So we are talking about the top ETF stories of 2024 and the outlook for 2025. Eric, welcome back. Great to have you with us today.
Great to see you, talk to you again.
So last year was a remarkable year for the stock market and the ETF industry, and it was marked by so many milestones and record-breaking achievements. So U.S. assets, they surged past the $10 trillion mark, and inflows into U.S.-listed ETFs, they exceeded $1.1 trillion. But I wanted to start with Bitcoin ETFs because I understand they occupied much of your time last year. And I saw that CoinDesk named you as one of the 50 people who defined the year in crypto. So they said the Bloomberg ETF bros, you and your colleague James, they were must-listen experts in the crypto space. So, and I've heard similar things from some of my colleagues and friends also who are more into crypto than I am. So I'd love to start with your thoughts on Bitcoin ETFs and their success.
Yeah, no, I was like casually interested in crypto or Bitcoin before the ETFs, but I really got pushed into that world because of this. And every like 4 years, there'd be some like SEC ruling for one of them, and they always got denied for 11 years. So when BlackRock filed, and it was like, oh, that's interesting, it became like a big story. We covered it relentlessly, and we had gotten good sourcing. We were talking to a lot of people who were giving us good off the record commentary or on background commentary about what was happening. And we felt the winds change. And so we were in a way kind of like SEC whispers in a way, handicapping, whether these would launch. And then we built a new audience just like that. Because on Twitter, the more we talked about it, the more people were like, oh, you got to talk to these guys, because in the crypto world, there's a lot of false information being thrown around and people with different interests. But James and I think we're viewed as like nerdy fund guys. And so for that world, they were like, okay, we can trust these guys. I don't know who else I can trust. So we built up a reputation as being somebody who you could go to for good information. We were optimistic about their launch potential. They ended up launching. Then when they launched, we were pretty optimistic about their potential to gather assets. They gathered a ton of assets. But I will say they really superseded any of our predictions. We had predicted that they'd take in maybe 15 billion tops, 10 to 15 billion in the first year. They took in like 35. And so that's more than double our high end of our prediction. The returns helped a lot. IBIT, I think, went up 100% in its first year. That'll help. Timing is everything in an ETF launch. So yeah, they broke all kinds of records. I could list them all, but it was easily the biggest, greatest launch in ETF history. Probably once in a generation type situation. That's why I got so obsessed. It's because I and James, we recognize this is just like highly unusual. And an opportunity to grow our audience.
Mm-hmm. Right. They were immensely successful, and because there was so much pent-up demand from retail investors who were waiting for more than a decade, they wanted the convenience and safety of the ETF wrapper. Now, you mentioned returns. So Bitcoin more than doubled last year. And probably the surge after November, after the election, was driven mainly by the optimism regarding a crypto-friendly administration. But before that also, Bitcoin did very well. Do you think that surge was primarily driven by these ETFs?
Yes. So I actually conflict with the Bitcoin people a little bit here. I think most of the move from 25,000 to about 70,000 was because of the ETFs. The move from 70, 80,000 to 100, I think, was Trump winning. But at the time before Trump, there were no other narratives. So I think ETFs really are responsible for a lot of that increase. I would even go even further and say that the sort of reputational damage and stench left over by Sam Bankman-Fried in terms of FTX, that was major for regular people. They're like, oh my God, yeah, I'm glad I didn't do it, or what's, I think they wrote it off. But then comes BlackRock and Fidelity and these very trusted brands. And they basically, Larry Fink's going on TV and talking about why it makes sense to use this asset class. And here's an ETF. And oh, by the way, they're cheap. Oh, and by the way, they're liquid. That was major. And so to me, they didn't save Bitcoin totally, but they saved this cycle. Like they sort of lifted it up from this real beat up place that it was living in. And I'm not really sure what else would have done that at the time, but I think the ETFs really took it and legitimized it. And I can't overstate how much air cover an advisor has when they know that BlackRock's name is on the ETF name, and that Larry Fink is, okay with this stuff. And Fidelity, these are the most trusted financial companies. And so that's been major, and it's still going to be major. And so, yeah, there's data that shows that the two most important things for an investor when picking an ETF are fees and brand. And BlackRock Bitcoin ETF at a low fee is hitting both those. So if you were even mildly interested, you're like, oh, hell yeah, let me invest in this. This ETF's perfect. If you hate Bitcoin, don't like it, think it's a scam, then even BlackRock won't make you invest in it. But for people who were like into it, I also want to say that I think the ETFs also decrease so much friction. If you were to try to get your own wallet and stuff, it's a kind of a painful process. In addition, I heard some people that are in LA had their seed phrase, which is something you have to remember to get into your Bitcoin, was in their house and it burned down, and like they lost their Bitcoin. So an ETF takes care of that problem too. So less friction, security, cheap brand. I mean, it's just checking so many boxes that in retrospect, I guess it's not a surprise it was a big hit.
Right. I totally agree with you. And this year, Bitcoin has faced some selling pressure, and some experts are talking about that ETF investors might be taking some profits because these ETFs are now over a year old. So the gains are now long-term capital gains. Do you agree with that?
Yeah, maybe. I think if you look at let's just look at IBIT, right? So it's got $53 billion. And if we look at the flows, I mean, it's had 4 or 5 days of outflows in the past 5 weeks. So one out. It's very light. And then before that, it really never had outflows, only inflows. It's pretty minor. I mean, if we were to net that number, it's still net positive. So I think when you get a big ETF like IBIT, people are trading it a little bit, but I think the bulk of the people who bought it and put it in their portfolio as like a 1 or 2% allocation, I think they're just in it. I don't think, looks like 1% of the assets are moving around. 99% looks like it's totally stuck, right? At least for now. So I don't know about any massive profit taking. I think sometimes when a ETF has nothing but inflows and there's a day of outflows, it's like, oh, what's going on? But you have to remember that like ETFs are used by market makers and like they're used to hedge, and you don't know what people are doing with them. And so sometimes it's hard to tell like one day of outflows. Now, if IBIT saw like 10 straight days of outflows and it equaled like $10 billion, I would be singing a different tune. I'd be like, absolutely, people clearly are spooked. This, maybe they won't come back, but this is nothing like that. This looks like most people are in there. Possibly you'll have people taking some profit, but my guess is people are looking at their statement and going, "Oh, my little hot sauce allocation here in Bitcoin is really doing well. Good, I'll just stick with that." Like that was the point. Where you might find some people taking profits or selling it, in my opinion, is if the stock market were to have like 6 to 12 months of a downturn. Not a month or a week, but like a 2022. I think that people will then look at their statement and be like, Bitcoin moves a lot with like high beta stocks. They'd be like, well, I'm not going to sell my stocks. I'll sell my Bitcoin. Like it might be the first thing they sell or one of the first things before they would touch their stocks if they're nervous and just wanted to feel better. But so I wouldn't look for any real market selling unless there's a real long-term downturn in the stock market. And with Trump in the office, and I know how much he loves to sort of brag about the stock market and keep rates low, doesn't seem like that'll happen, but you never know. Like nobody predicted COVID either. So I don't know. I'm mostly sticking with our take, which is that these are going to be stronger hands than people think. And they're probably not going to bail. But even if there's even if there's a 2-year downturn and half the money in this stuff leaves, there's still ETFs that still exist and trade. And if Bitcoin had like another cycle rally in 5 years, the ETFs are there. People will buy them again. My point is, whatever happens now, they are on the map. They are a category that exists and will exist, well beyond when I retire.
So let's move on from Bitcoin to other major ETF stories. So last year was a remarkable one for ETF launches as well. 750 new products were introduced last year. And it seems that now every third ETF has some kind of complex or derivative-based strategy. And some of these complex strategies make a lot of sense. For example, I'm a fan of buffer ETFs or defined outcome ETFs, particularly for risk-averse investors who are in or nearing retirement. But there are some other products which don't make a lot of sense, make me scratch my head a little bit. For example, yield max ETFs. So I was interested in your thoughts in general on this trend of pushing too many complex features into ETFs, and then maybe talk a little bit about your favorite new ETFs of 2024, and if there were any that didn't make any sense to you.
Yeah. So buffer ETFs are, I didn't think they'd be a hit. They just seem too complicated for me. These are popular things in the institutional world called structured products. And what they do is they use options to sort of lock in your future returns. So they, in some of these cases, they'd be like, look, we're going to kill all downside. But you only get up to 9% of the upside. Well, for a lot of older investors who want to, not lose their money that they made in the past 30, 40 years, it's a pretty appealing notion. And one underrated part of the success of buffer ETFs is the fact that bonds, the 40 of the 60-40 went down in 2022, almost as much as stocks. So stocks were down 18%, bonds were down 13%. Well, that never happened before, really, for a boomer. The bonds always offset the stocks, like in 2008 and other crises. The bonds are supposed to be what goes up. Well, they both went down. And I think that scared some people. And I think that opened the door for some of these more creative solutions to take away their anxiety and make them, have peace of mind. So I'm not surprised they're a hit. They have the 60, 70 billion in assets. Still, though, 60, 70 billion in assets is 0.6% of all ETF assets. So they're still small, but they certainly have created a category out of thin air and deserve to be their credit. The single stock ETFs, same thing. Those have 20 billion, which again is still pretty tiny, but they had 1 billion last year. So they grew by 20-fold in the past year. And I think similar to how the buffer ETFs cure an older person's anxiety, the single stock leverage ETFs cure a young person's boredom. This is just fun stuff to act like a degenerate with. And basically, some of this stuff goes up 10, 20% in a day. There's some legitimate uses for them, but I just think it's mostly just people wanting to have fun and gamble. I'm okay with it. Again, it's such a small portion of the industry. Fine with me. I mean, I think the 2X micro strategy was probably one that stuck out last year, if you ask me. I'm like, because when we looked at the numbers, this is the most volatile ETF ever introduced in the United States.
Right.
So to put this into perspective, this 2X micro strategy is 4 or 5 times more volatile than a 3X QQQ ETF. I mean, we're talking like 25, 30% a day potential up or down. And in effect, it's a 4X Bitcoin ETF because MicroStrategy stock is 2X Bitcoin. And then these are 2X that. So it's really like a 4X leveraged Bitcoin ETF. So I wasn't surprised they got a lot of love, but there was a couple days where they were in the top 10 most traded ETFs in America. They both have over $1 billion. Just really wild stuff. But I'm okay. ETFs are a big tent. I would call that wing the rated R wing. There are definitely like rated G ETFs for people, and they take in a ton of money. And there's also, stuff in between. And then there's definitely a wing that really you should be careful, for people who know what they're doing. And I think when you look at the volume of some of them, they trade a lot. And that tells me people at least are trading them, because when it comes to leverage ETFs, if you do use them, trade them, don't hold them. That'd be my advice.
Right. People should remember that these are risky, very risky products. And talking about MSTU and MSTX, there were days when they were not doing what they were supposed to do because they were using options, not swap contracts. So any thoughts on that? You mentioned hot sauce earlier, and that is a phrase coined by you. Do you think these were ETFs where hot sauce became too hot?
Yeah, I mean, they're going to keep pushing the envelope. I think one of them will have to terminate at some point. Like, let's say we have a COVID-like sell-off where there's limit down days. One of these is going to blow up. I would say blow up. It's not that. It just means that it goes down too much and it has to just goes down like 90% in a couple of days, and the ETF just has to retire. Blow up might be too strong of a word, but we've had multiple leveraged ETFs sort of die off during the COVID days. Remember, there was like triple leveraged oil and stuff. Those went away. So we had, I think, 70 triple leveraged deaths in COVID era, and everybody seems to be okay with it, because like since then the other leverage ETFs trade, these new ones come out, and there'll be a situation where maybe some of these just are stretched too far and they have to just retire and go away, and everybody's like, oh, there's going to be some I told you so's. But I just think this is kind of part of how ETFs roll now. There's always going to be a wing of people trying, really exciting, get your blood flowing, packaged adrenaline type products. I just think, it's just the way it is. I don't really pass judgment on it.
Okay.
I just try to educate.
That makes a lot of sense. So another topic which is being discussed a lot lately is U.S. exceptionalism, because over the past decade or so, U.S. large cap stocks, particularly mega cap stocks, they have trounced almost every other asset class in the world. And this performance divergence continues to widen. And we have seen that investors are increasingly favoring US stock ETFs now. They are not interested in international stock ETFs. And I know that you have team members covering ETF markets in Europe and Asia. So I'd love to hear your thoughts on investor interest in US stock ETFs, which are listed abroad. So when you travel abroad and hold workshops and meetings, do people ask you about ETFs which are specific to their country, or is it mostly whether they should be buying QQQ or triple leverage NVIDIA ETFs?
Well, it depends on the country. Like in Europe, they're not gamblers. Some Asian countries, definitely. I mean, South Korea arguably would put US to shame. But Like Switzerland, I was in Switzerland. They very calm. They don't really need to gamble. It's just depends where you go. I will say everywhere you go though, there's definitely interest to get exposure to the Qs. But every country has a Qs product. It's just not the QQQ. It's something over there that invests in the NASDAQ 100. And we did see an outsized portion of money from other countries go into US exposure ETFs. And in China in particular, those investors, the Chinese government doesn't let you invest outside the country that easily. So there's quotas on some of these US ETFs that are listed there. And the people wanted to get over so bad that the premium of the ETF shot up really high. So the price was way higher than the NAV because there was such a stampede to try to invest in the US. So that's been, we have the, envy of the world in terms of stock markets for sure.
Right.
And it's always been that way. We will have a period where it goes down, but the more I look at history and the more I study Jack Bogle, which I wrote a book about him, he said you don't need international. And I don't want to say international won't have runs where it does better, but the more we live in a global economy, US is going to have international exposure ipso facto anyway. And that you don't really, the currency exchange risk, the currency risk is unnecessary. The only thing is if you have only US stocks or you just stick to that and you don't have international, it'll be a touch more volatile because in the times where international might have a nice run and US is down, that can lower your overall portfolio volatility, give you something up when something else is down. But it seems to me that if you can stomach a little of that volatility and make your way through that months or years that happens, I agree with Bogle that you probably just, the US is fine. It's just a country that's just so like designed to kick butt when it comes to corporations and like taking risks and all that. So in Europe, they're just so weighed down by regulations, and in China, like there's the governments in a lot of these other countries are way more overbearing. In the US, there's just a culture of risk taking. There's bankruptcy laws that help. And so as I get older the older I get, the more I appreciate the uniqueness here. And I understand what Bogle was saying. Mm-hmm. All that said, there's going to be times where a continent or a country or even international as a whole has a better run than the US. I point to the 2000s where the US was flat. I mean, it went up, but it went down in 2008 and it went down in 2001. So you had two really rough downturns that negated all the ups. So it was like net zero for the whole decade. And emerging markets were up. I want to say maybe 6% a year, not a ton, but 6% annualized is pretty good. So, if we have a period of like 3-5 years where the US lags, maybe you'll find people, latching on international. But when you look international, you have to ask yourself, like, where's the growth? Are you just buying international because it's due or because the PEs are low? What's the story besides that? And it's hard to find that sometimes.
Right. And you, as you pointed out, and as Bogle believed, that these US companies already have so much exposure to international markets. So that's why he was not a fan of international investing. And another area which he did not like much was private assets, which also you have mentioned a little bit in your book. But this is an area which we'll be watching this year very, very closely because the largest asset managers are now racing to bring these private assets to retail investors. BlackRock, we have seen, is making a significant push into private markets, and State Street has partnered with Apollo. So we'll be watching that filing very, very closely. And we have already seen some initial steps, like a couple of private credit CLO ETFs. And there's this X-over ETF, which has some exposure to SpaceX via SPAC. So do you think we'll see more private asset ETFs this year, the real ones?
Yes. X-over is a great example. This one had a strategy for like 5 years and like nobody cared. And then it just switched in August to be this public-privates crossover fund. And then it added SpaceX in December. And SpaceX is 10% of the portfolio. The rest of the portfolio is like public equities. And since adding SpaceX, it's basically seen a flow-a-thon. It's now well over $200 million. And what's interesting is that Kathy Wood put out a ARK Venture Capital interval fund that has SpaceX along with a lot of other private companies, and like nobody cares. And that tells me, and that's been out for like 5 years. That just tells me that like, and this is something that we've been saying, is that even if the ETF vehicle isn't the perfect vehicle for a private equity or credit exposures, it's how people want it. And I think that you can put something that's less liquid or even illiquid in an ETF, and it will just sort of trade like a hybrid closed-end fund. The price will deviate from the NAV a little bit because the market makers have to adjust. But I think people are okay with that. They'd actually rather have that than deal with a mutual fund or interval fund or hedge fund with or private equity fund, which many don't have access to. So I think the industry senses this and is going to do everything it can to push the envelope on this. So I think we have got X over already. That's the one on the equity side. Then the Apollo one, if that launches, that's even more interesting in a way, because Apollo is a huge private company, a leader in this, and their name's on the label, and they're going to help give liquidity. Although some, Nate Geraci, my colleague at the ETF store, pointed out that if they're the ones providing liquidity, that's a little bit of a conflict of interest. But I also think State Street on the label helps, because State Street is going to fight for its investors and not let Apollo do anything weird. So I kind of think that negates that. But anyway, there's definitely some debate around this. But I've seen this industry do this before. Once it starts to get on something like a dog, on a bone, it's not going to let go. It's going to keep pushing the envelope. And with the new SEC chair being seemingly more libertarian than Gensler, I could see multiple private type products in the market. I don't think you'll have 100%, because that might be too much to do, but you're going to see these baby steps, 10%, 15% hybrid. And I think that's ultimately going to be, and what succeeds is where you'll see more product. But it's certainly like another new frontier that is probably it's probably the number one thing that we're watching this year. One of about three things, I think. So definitely.
That's going to be very interesting, and there are definitely some challenges, but the ETF industry is very innovative. These providers are very innovative, so I'm really optimistic about these private asset ETFs. And you mentioned Kathy's interval fund. I had looked at the performance, and last I checked, it had underperformed the S&P 500 index since inception, and plus it's expensive, so that's why investors love the ETF wrapper. So let's now talk about your ETF outlook for 2025 in terms of asset growth and product innovation.
Yeah. So, our outlook is basically that the core beta strategies, that's sort of like core passive. The ETF industry is obviously going to just continue to find new ways beyond that to attract money. And so we've covered a lot of this. I mean, we've stolen thunder from our outlook here. As I said earlier, I think, thinking out of the box, like how can we solve investor problems? How can we change their moods? That's going to be the new white space. And then I think on the digital asset front, even though Bitcoin was the big deal and it will continue to be, there's going to be these other coins probably approved. Solana, XRP, Litecoin, HBAR, which I even had to look up what that was. There's just going to be a bit of a Pandora's box opened, I think, on the alternative coin front. None of those will do that well. I mean, they'll have a little niche. Nothing will be like the Bitcoin ETF. I think Bitcoin is like gold, and these other ones will be like silver, platinum, palladium. So they're interesting, but nowhere near the big deal that Bitcoin was. But I'm looking for a lot to go on there. And with the new SEC chair, I think the Bitcoin ETFs may be able to add in-kind creation redemptions, which they don't currently have. And then we are also awaiting the ETF share class situation, which is wonky, but about 40 big managers, mutual fund companies, are asking the SEC to be able to take their mutual funds and add an ETF share class into them. This would be really interesting. This would allow people to just move over from the mutual fund to the ETF without a tax consequence. And in
that
addition,
would be huge.
Yeah, no, that would be. I mean, I would have to think most people would switch now if they could without the tax hit. We sometimes ponder how much money is stuck in mutual funds, like how much is actually like held hostage by taxes, and it's got to be like most of it, you know. Certainly, some people might be willing in there, but I think a lot of it would move if it could. So this could help speed that up. So if that's approved and you have these big firms adding an ETF share class, you could see flows come over even quicker. And then, of course, the market. You know, we have a prediction that ETFs globally will hit 35 trillion in 2035. Right now, they're at about 15, but we only anticipate 10% growth a year, maybe 6-7% organic flows, and only 4% from the market. That's really low, but the market's been so on fire lately, it's got to take a breather, right? But last year, global ETF assets grew by 32%, which is astonishing. So that already moved up our prediction to 2034. So anyway, if we get the share classes, that could make up for some of the market downturn in asset growth. But anyway, we're very bullish, and we think that there's two competitors that are coming along trying to like compete with the ETF, but they've really done nothing really, and we think there's they're no big deal. What's direct indexing and tokenization? For now, the two of them just don't really have enough of a reason to get an investor to switch. With an ETF, you log on to your brokerage account, you type in a ticker, you hit a button, and you own almost anything under the sun for a low fee and no friction in a tax-efficient wrapper. It's going to be very, very difficult to disrupt that. That's why I think the ETF industry is in the third inning. It's just getting started. Mutual funds had a 100-year reign. ETFs are only in year 31 or 32. So I could see another, decades of ETFs ruling simply because of how powerful that value proposition is that I just told you. So until something else comes along and is able to like make sense to like, hey, actually that's a better deal, I'm skeptical.
Totally agree with you. And I'm very excited about the year. So last and the most important question, do you have any top ETF picks for 2025 or ETFs that you will be watching very closely?
Yeah. So, I mean, I'll give you, we have a thing called 25 ETFs for 2025. And a couple of mine were watching VU, boring, but VU is going to pass SPY in assets. So sometime in the next like 7 months, you're going to see headlines saying that VU is now the king of ETFs. And when it passes, it's going to be the king of ETFs for like a long time. This is like a whole regime change about to happen. I'm also watching JAAA, JAAA, which is the Janus CLO ETF. CLOs, collateralized loan obligations, are interesting in that they are real low vol. Like they have low volatility, but good returns and low correlation. So there's such a really good diversifier. And with bonds not doing well, JAAA could be like a bond solution for many people. And JAAA so far is like taken in like $11 billion in the past year. Amazing invention. Again, that was a white space they found. In that case, it was a sort of area of the bond market, not something, unrelated to asset classes. Anyway, so JAAA is another one. And then I like NUKZ, NUKZ. This is one, again, I'm not saying it's going to go up or down. We don't make predictions, but the uranium story is really powerful lately because a lot of the big tech firms are doing AI. They're in a race to do AI, and to do AI, you need a lot of energy, and they can't rely on like fossil fuels really. So they're all building these or buying nuclear reactors to basically make the energy for AI. So if you believe AI is going to be some big deal, nuclear stands to benefit. And so we've been watching the uranium area, NUKZ in particular, ticker and NUKZ, though it's now bigger than clean energy. And so that's something I'm watching as well, because that story is also interesting to me, because if you're trying to fight climate change at all, I think it's pretty clear now that nuclear has to be part of that story. So, this is a big deal in the energy area. Again, so those are and that would be called a thematic ETF. And so we look at the big stuff and the themes, and those are just a couple that I'd say we're watching this year.
Very interesting. Wu, JAAA, and NUKZ, all very interesting picks. We'll have to leave it there, but thank you so much for joining us today. Really enjoyed our conversation. And yeah, one more question. Where can people find your research easily? Twitter or X or LinkedIn or Bloomberg.com?
Most of my research is on the Bloomberg terminal. So assuming you don't have one of those, X at Eric Balchunas, or if you are a podcast fan, Spotify or Apple has my podcast called Trillions, which is all about ETFs. So those are two free ways to find me and get free samples from the research that we do. Excellent.
Thank you, Eric.
Thank you. It was a pleasure.
That was Eric Balchunas of Bloomberg Intelligence. Let's quickly recap the ETF tickers that we discussed. So he mentioned IBIT. It is the iShares Bitcoin Trust ETF. IBIT. VOO is the Vanguard S&P 500 ETF. Then he talked about JAAA. It is JAAA, the Janus Henderson AAA CLO ETF, and the NUKZ ETF, Range Nuclear Renaissance ETF, NUKZ. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast, and make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.